So, thanks, Jordan. I'm certainly a lot more depressed than when I arrived at Stones Corner this afternoon. Everyone can hear me all right at the back? I'll throw things if they can't. He also reminded me that I was one of those people who thought the best time to take out a mortgage, my very first mortgage was in the late 80s. I think I was at 17%, and weren't they good times. Let me get this going. Oh, this better work. So, I've been asked to have a brief chat about self-managed superannuation. Jordan alluded to it, he certainly has one. And obviously I want to incorporate precious metals into the discussion. I'm going to leave out a lot of stuff about self-managed. It's quite a technical area. It can be very simple. There's a lot of traps as well, and I'll bring up a couple of those. We'll run a quick agenda. Why would we want to use one? How to set them up? The different phases of superannuation. So I'll spend a couple of minutes on tax and why we use them. Obviously tonight, collectibles and personal use assets with bullion and coins. Even a couple of days ago, we were debating what some of the rules and regulations about collectibles in self-managed funds. There have been some changes in the last 2 years, so I'll briefly touch on those. If we're going to spend all our time putting money in, obviously it's our money, we want to get it out at some stage. So how we go about doing that? Estate planning, Centrelink, using it for insurance, and then a brief overview of how they work. And I'll be fairly swift. Making decisions about our financial future is all about making confident, informed decisions. Please don't make any confident, informed decisions based on tonight's presentation. Obviously, go and get... Yes? Is that better? Yes. Oh, okay. My apologies. Don't make any decisions, don't make any rash decisions on tonight's presentation only. So why do we use the self-managed fund? You always hear about control and flexibility, but let's go a bit deeper. Specifically, we want to use non-traditional assets and direct property, precious metals, collectibles, coins, artefacts, artworks, those types of things. Shares, managed funds, cash, term deposits, if they're what you like, they can be in any super fund available in the market today. So for using self-managed funds, you're probably going to want to use something slightly less traditional. We can use in-specie contributions. We can transfer our assets into superannuation. You can't use that in a retail fund. Tax minimisation, we'll touch on that a little bit later. There are some excellent estate planning opportunities that you can use specifically with self-managed funds. You can fund your insurance. You can use it for asset protection. I won't touch on any of that this evening, but currently the bankruptcy laws still protect superannuation from creditors under certain circumstances. And obviously it's a pretty obvious alternative to the other major options, which are industry or retail funds. So Nathan mentioned it earlier, super is our second largest asset that we own, and self-managed super is the largest, fastest growing part of the superannuation industry. So it's a bit of a juggernaut, and we probably need to know about it. So how to set one up? We need to obviously make sure it's for us, and there are some reasons why you wouldn't use one. So is it right for you? Work out how many members you want. Generally it's mum and dad. There are reasons you would include your children, and there are reasons why you wouldn't include your children. You can only have a maximum of 4 members in them. Create it with a trust deed, execute it. There's some paperwork that you need to lodge with the ATO, and then obviously getting your funds in there. Prepare an investment strategy. It's a really important part. We're acting as our own fund manager, and the regulator wants to see a document that explains what the objectives of our fund are and how we're going to go about doing it. We need that document in there. You must consider the life insurance needs of members. It's a new regulation. We have to consider it. Doesn't mean we've got to buy insurance, but we have to consider it and sign off that we've done it. Managing it with compliance, day-to-day running, and remain informed. There's been lots of changes with super and also self-managed. It seems to happen every year. There doesn't seem to be any, I don't think it's going to stop anytime soon, although the Liberals reckon that they're going to keep their hands off it for a little while. Really important aspect is the sole purpose test. Lots of people ask why they can't do certain things with their super. It's the Part 4A version of the Tax Act. It has to be set up for funding the retirement needs of members or providing a member to dependents if you die. So the question then comes, obviously, from investors, how do I do this? How do I get around? Well, if what you're trying to do can't be linked back to that purpose, then you're probably trying to break the law. And obviously, don't get caught. So we talk about self-managed funds, and I'll continue to use the term, but there's two options. There's a self-managed fund, which is regulated by the ATO. You can use individual or corporate trustees, which is a proprietary limited company. Has to have less than 5 members. Generally, the members are trustees and the trustees are members, and you're responsible for any compliance and regulation. But there are other funds called a small APRA fund, and they're rarely used, and they're probably better than that. They cost a little bit more, but they're regulated by APRA, which doesn't make a hell of a lot of difference, but it uses an approved trustee company, and there's about 70 of them in Australia, and they will handle all the regulations and the responsibilities of trustees. So if you don't want to do those, you can either outsource it as an SMSF to your auditor or accountant or compliance manager, or you can use a small APRA fund and they will handle it for you. So how to get the funds in? The main way is to roll some money in, as Jordan told us. Obviously, we can throw some contributions in as well, which is SG, salary sacrifice, personal contributions. So SG is the 9.25%. And the rules are exactly the same with getting money into super in regards to contributions. The $25,000 limit, 35 if you're over 59 this year, 150 grand a year for non-concessional. We can also transfer assets in, but we are subject to some rules. And obviously, if I've titled the slide Traps, obviously you're probably going to know what the answer is. But if you want to just consider this particular point, a member owns precious metals in his own name and would like to transfer into his self-managed superannuation. It seems quite a normal transaction that you might like to partake of. However, unfortunately, there's rules that say a self-managed super fund can't acquire assets from a related party. As a member and trustee, you're obviously related. So there are 2 exceptions, neither of them is bullion. Listed securities, shares, and also business real property. Note that it doesn't incorporate investment property. So if we change it around a little bit, a similar situation, but the member is going to have his SMSF buy the precious metals from him at market value and on commercial arm's length terms. Should that change anything? Anyone want to hazard a guess? Obviously not. No, the rules haven't changed. Even though you want to make a transaction on a commercial arm's length basis and it seems perfectly reasonable, there's a whole bunch of rules and laws that you have to be aware of that will get in the way. And unless it's a listed security or business real property, you won't be able to transfer assets in. The same is not for transferring assets out. The rules don't apply on the way out. So when you're running your fund, you're going to be in either accumulation or pension phase. And you're going to need to consider these issues: diversification and risk management, which Jordan spoke of. The objectives, keeping records, valuing your assets, things such as collectibles need to be regularly valued. Very easy to do with shares and bullion because there's a spot price. Generating income, obviously collectibles and precious metals don't generate income, so you'll need to find a way around that. And specific rules regarding collectibles. Now, in the accumulation phase, this is when you're putting money into your superannuation. You're taxed at 15 cents, and capital gains tax, if you hold an asset longer than 12 months, you're taxed at 10%. So you get a bit of a benefit. Peter asked me to just mention that if you own precious metals in your own name, the normal capital gains tax rules apply, and there's a 50% discount if you hold it for longer than 12 months. So normal capital gains. In the pension phase, you cannot put contributions into your superannuation. If you need to, you have to set up a separate accumulation fund. The benefits, though, are the income tax is 0 and capital gains tax is 0. And this is the fundamental reason why we're building assets to move into a completely tax-free environment, which is, of course, perfectly legal and encouraged by our government of the day. So one of the questions is, when should you move into pension phase? Well, there's 2 main reasons. One is a practical sense. You've left work and you need to replace your income. So that makes sense, you need to generate an income. The other one is more opportunistic, and it's for tax purposes. Because pensions have a zero internal tax rate for both income and capital gains, and in certain circumstances are entirely tax-free when you take money out, there are obvious opportunities that having funds in that environment are going to pay a hell of a lot more tax, a whole lot less tax, and you're obviously going to be in a better financial position. The underlying assets just stay in there. The paperwork and documentation merely informs the trustees and the regulator that you have now moved to pension phase, so nothing changes there. There is no beneficial change in ownership of the underlying assets, so moving from super to pension phase within a self-managed super fund environment does not trigger any capital gains tax. So one of the opportunities is running an accumulation and pension at the same time. That's called a transition to retirement strategy, which is TTR. Self-managed superannuation trustees often don't use these strategies like the retail clients do. They're just not getting advice from their accountant or planner. You can segregate assets. An asset which has high capital gains can be moved to pension phase and then sold off. If you're in pension phase and you sell your asset, you pay no capital gains tax. So segregating specific assets to fund certain member accounts between the different members, they're the sort of things that you can do. Centrelink is treated the same way as retail funds. And I'd have to say that strategy, using these types of strategies, is the most underutilised benefit of self-managed funds. The concentration seems to be just on the investments alone. I'm not going to go through all of this, but we're talking about this section here. Coins, medallions or banknotes, and collectibles, and whether bullion should be treated as a collectible and as it have to comply with the new rules. And specifically here, coins and banknotes are deemed a collectible if their value exceeds their face value. So that's how you can determine whether or not you have to comply with the new laws that came in July of 2011. If you have coins or artwork or statues or artefacts, if a coin is worth more than the face value, then it's a collectible. And you've got a few extra rules that you've got to comply with. Specifically all these things, but storage, investment, written records, etc., etc. So if you have precious metals in the form of bars or bullion, you're not required to comply with these particular aspects of the law. However, it's considered best practice if you do. If you think that not insuring your gold or not storing it in storage or not keeping written records or not valuing it regularly, they're all pretty obvious things that you would want to do to maintain the integrity of the value of your super fund. So whilst they're not law for bullion, it's a good idea to put those things in place anyway. So to get funds out of a super, you can't just take money out. Early release schemes are a big ticket item on the ATO's radar, and it doesn't have to be intentional. If you accidentally, a common scenario is you've got the personal checkbook and you've got the SMSF checkbook in the top drawer, you pull the wrong one out and write the wrong thing. It will cause so much hassle to rectify that breach, and when you're using an accountant who does your books after the end of the financial year, the breach has already been recorded for that financial year and you can't reverse it. So it's a pain. You really do need to be careful that you're not making those very obvious mistakes. So being over 55 or 60 or 65, these are all the things that generate conditions of release to move to pension or lump sums. Taking money out as a lump sum or pension, lump sum there may be some tax. Pensions are tax-free over 60 and a small amount of tax between 55 and 59. And it's a good idea, if you choose to take a lump sum of money out of your super, then someone's going to tell you how much tax you owe. The point here, the last point here, is just making sure, check before you make the transaction. Just work out if anything's going to attract any tax. We get $175,000 lifetime tax-free withdrawal from superannuation, and if we go over that accidentally, we're going to be taxed. There's no point. You might as well take it as a pension. There's easy ways around it. So our options with estate planning is you can run a binding death benefit nomination. You may have heard of those. They're fairly popular. You need to renew them every 3 years, but with Some retail funds and some self-managed super trust deeds, you can actually have a clause which deals with a non-lapsing binding nomination, so you can set it up for good and never change. You can have pensions payable to minors. They will have to be cashed out at age 25. Reversionary pensions is where, if you're a bit older and you just want, if you pass away, you just want your pension to be paid to your spouse. Administratively, it's the easiest way to do it, keeping in mind that at that point you are now a single member fund, and a single member fund with a single individual trustee can't be a self-managed superannuation fund. So of all the things that have got to happen at that time, and obviously it's a time when there's other things on your plate, a reversionary pension in advance, setting those up, is actually quite a smart move. A non-dependent is someone who's not your spouse and not a child under 18. There are other conditions, and if you pay a death benefit to a non-dependent as defined under the superannuation law, there is almost always tax to be paid. So that needs to be treated, understood in the estate planning when you're handing different assets out to different beneficiaries. Superannuation, believe it or not, is a non-estate asset. It's not distributed via your will. If you think it through, it's owned by a trustee. It's not yours. You can deal with it through your will if your super fund pays to your estate and then your estate then directs it. But your will can't directly direct the funds to beneficiaries. So just keep that in mind. If there is a clause in your will that does do that, it'll be ignored. It's just a straight up rule. So with Centrelink, treated the exact same way. If your accountant is doing your books about 9 months after the end of the financial year and you're waiting for a pension, keep that in mind, because you'll probably want to kick off your age pension and he's not getting the valuations or documentation prepared, so you might have to preempt that. Where one spouse is younger than the other, I'm referring to superannuation is not assessed in Centrelink if you are under age pension age. So if there's a differential in age, you might consider that you move your money out of the older member, contribute it to the younger member. The older member gets Centrelink age pension and the superannuation is not assessed until that younger member hits age pension age. And that's a very common strategy, cash out and recontribution, but to the other spouse, of increasing your Centrelink benefits. Perfectly legal. There are obviously caps, but you just need to work around those. Vet affairs happens really same way. So using insurance to cash flow, self-managed super to cash flow insurance, you can put life cover, TPD, salary continuance or income protection in there. You can own the fund and pay for it through your self-managed superannuation fund. Funnily enough, transferring a super fund from your own name, transferring insurance from your own name into the self-managed superannuation is not allowed for that same related party rule that I mentioned earlier. So you can't transfer an insurance policy and just start paying for it with your super fund. There are solutions around it, cancel and reissue, re-underwrite, any of those things, but you can't just transfer it in. There are tax consequences of insurance payments from super, and you can the insurance company will pay you a lump sum into your super, but you may choose to pay yourself a pension for tax reasons. So finally, just the whole superannuation, I look at it like this. Getting it started, you've got some compliance documentation that you need to work with. We want to get the money in. Generally it's via rollovers or contributions. You'll make some decisions about the types of investments that you want to make. You'll then administer it either using corporate trustee or a service such as Jordan was talking about. And then the strategy is the glue that ties it all together. So understanding the laws, the rules, the regulations and the advantages that you can manipulate to get a benefit legally, I believe that's one of the most important aspects of it. Taking funds out as a lump sum or pension. And then finally, as a result of tonight's presentations, both of them, what we're looking to do is decide, is there a place for precious metals to form part of an SMSF investment strategy? I'll leave it there. It's really important you don't go and try and put anything in place on the back of tonight's presentation. I've left out a lot of stuff. But if there's any questions, I'll be staying around and happy to answer them. Thanks for your time.